Good afternoon or good morning, everyone, depending on where you are. My name is Joel Comerford, and I will be the host of today's webinar. First of all, I would just like to apologize to everyone who went to participate in last week's webinar. We had a bit of unfortunate technical difficulties, and yeah, it was a whole kerfuffle, but we did manage to record the episode regardless. We asked a couple of questions, and that is available on YouTube should anyone need to catch up on that. If there are any accounting or tax related questions from last week's webinar that anyone wished to ask, keep in mind you can ask those today. To Tim. And unfortunately, this isn't a legal-based discussion either. So if anyone did have any questions related to law that they wish to ask Damon, when I send the email out today for everyone to view, as in the slideshows and everything else from today's webinar, please feel free to drop in any questions you had, and I will endeavor to get those answered for you. Now, thank you all so much for joining us today for the special Lawpath webinar, End of Financial Year Tax Compliance for Small Businesses, Avoid Penalties and Stay Compliant. So whether you are a sole trader, a startup founder, or running a growing business, this session is packed with practical strategies to help you get ahead of tax time, avoid fines, and feel confident heading into the new financial year. Now, we know tax isn't always the most exciting topic, but we are going to hopefully make it easy, relevant, and even enjoyable. Why is that? Because when you understand your tax obligations and take actions early, you're not just avoiding penalties, you're giving yourself more freedom to grow. So as we go through each section today, keep these questions in mind. Will this decision make me or my business better? Can I sleep better at night knowing this is taken care of? And even though you might be a smaller business for now, in regards to potentially signing up onto one of our plans, i.e., the tax, for example, think things might be fine now, but in 6 months from now, will this approach still work for my growing business? Yes. Now, for the main event, we're joined by a very special guest, Timothy Quinn, our head of tax and accounting at Lawpath Tax Advisory. Tim is a chartered accountant with 17 years of experience in tax planning, business structuring and compliance, and financial strategy. Keep that in mind. He's worked at a director level across the industry and now leads our team here at Lawpath, helping business owners just like yourself optimize their tax position and build financial strategies that scale and protect your business. Now, I am aware that there are other accountants in the call today, so please, guys, if you have any questions, please speak up. I would love to get your take on some of the topics that Tim is mentioning. And guys, we will have a Q&A for those new people, Q&A at the end. So if you have any questions, you can pose them during the chat. They will be addressed at the end. And for, again, anyone who's new, this session will be recorded and we do upload it to we upload each episode to our YouTube channel. Just go to YouTube, type in Lawpath. You'll be able to see every episode we upload and any previous one we've done as well. Now, without further ado, Tim, please go ahead and take it away.
Thank you very much as I turn my camera on. Fantastic. Thank you, Joel. I do respectfully disagree with you on the issue of tax not being the most exciting thing in the world. I completely disagree. I think tax is fascinating. But more importantly, I do recognize that most people disagree with that. So if you are a small business owner, let some widow like me who's into it, who finds it interesting to take care of it. Joel, are you able to share those slides for us at all? Or do you need me to step in?
Do you have the slides available? I should
I don't have them at hand, but while I'm talking, I can quickly find them for you.
appreciate it. Thank you, Tim.
Problem at all. Is everyone excited for the end of financial year? Is this the time of year that you're all excited about, or is it more of a looming dread? I'll wait for some answers to come through there. Potentially little bit of both. Got someone in the chat. Dread. Yeah, I get that. I certainly understand why that that might be the case. It's a complicated time, and more importantly, it's a time where there's a lot going on. We've got sort of end of the March BAS period. We've got the end of this financial year. We've got the lodgement deadline for last financial year. It really is all over the place. It's a busy time for everyone. Can you see my screens there, Joel?
Certainly can. I
Fantastic.
certainly can. Everything's looking very nice.
Fantastic. Joel, should we skip the about Lawpath and get straight into it? And you can cover up the background of the Lawpath platform at the end. Well, why don't
Yeah,
we'll quickly talk about it. Look, Lawpath is really a platform for small businesses to do everything. It's a one size fits all, one stop shop. So if you've got legal, if you've got corporate secretarial, if you've got accounting or tax issues, you can basically come on board on one platform and have everything sorted out. It's really aimed at people that like to self-serve a little bit. So it's very much a platform for you to be let loose on, change some legal documents. Basically, we're trying to avoid you having to deal with lawyers or accountants as much as possible. For the bits that are easy and that you're happy to do yourself, go for it. Let loose. And then for the niggly bits, the really complicated, little complex bits where you really need good professional advice, then we're here to help. Joel's already given me a fine introduction. What are we going to talk about today? So it's going to be aimed at a bit of everyone. We're going to try and hit really small businesses, brand new startups, what we call scale ups. So companies that have been going for a little while and are looking to hit that next level, and just businesses in general, really, that everyone's got startup expenses and things like that. Let's get straight into it. A word of warning, and the accountants in the room will know what I'm talking about. The Bank of the ATO that we all lent on pretty much throughout COVID and even before that, the Bank of the ATO is closed. So where a lot of accountants and a lot of clients, a lot of small businesses would really put off their lodgements, they'd sort of do it when they got to it. I knew plenty of clients that would insist on only doing their BASs once a year, even if they were quarterly withholders, because every time you did the wrong thing, it was a slap on the wrist. If there was penalties or interest, you could very easily get them remitted. It became a way of leaning on this Bank of ATO as a good cash flow strategy. That has now come to an end, and the recent the recent budget announcements really made this very clear by adding extra funding to the ATO for their compliance methods. What we've seen is that those failure to lodge penalties are going up. They're being stamped on small businesses sooner than they used to. Now, these penalties are not tax deductible. So you're paying expenses out of your hip pocket that you don't get a tax benefit for. The interest on those late payments, the interest rates has crept up and up and up. And very, very soon, they're not going to be tax deductible. So from 1 July, you won't get a tax deduction for interest. Now, that is a huge change. That makes that effective interest rate more like 15, 16% when you counter into the fact that the interest will not be tax deductible. Superannuation, as we all know, if you pay it late, even by a couple of days, it's a huge hassle. It's become more and more difficult to shirk your superannuation obligations, which I think is good. But certainly it's something that you have to be really across unless you want to be hit with some very difficult penalties. The audit activity, I'm starting to get questions from the ATO on smaller and smaller clients. So it's not the top end of town anymore. Don't think that you're going to slip under the radar. Do get compliant and do stay compliant. There might be a time where you need to lean on the ATO with payment plans, with a little bit of discretion. Having a great compliance history will help you get that. And I have just seen that we've got some questions coming through on the chat. Loads of penalties. Yes, yes, there are more and more penalties. There are penalties for everything these days, and they're harder and harder to avoid. Uh, Shane, I'm very sorry to hear that your accountant hates you. I think we'd love to reach out to you and see if we can help you there. And Alberto just has shared a sad face emoji, which fair enough. But we've got the sad bits out of the way. Let's talk more exciting things. Let's talk about how we can help you. So let's quickly understand the basics. In Australia, as in most countries, we tax profits. We don't tax income. So every time you see that story that the Sydney Morning Herald runs once a year that says these huge companies with huge amounts of income don't pay any tax, this is generally the reason because we don't tax income. We tax profits. For small businesses, which is going to be most people in the room because the definition of small business is quite large, that tax rate is 25%. So you take your income, subtract your expenses, multiply by 25% with some adjustments. Because Slightly different treatment for tax than for just accounting, but that's the basics of it. So, how do we minimize tax? There's two big levers. It's not rocket science. Decrease your income, increase your expense. Sounds simple, right? Well, you don't want to decrease your income, do you really? You want to keep making money. What does that mean? What it really means is playing around with the timing of that income. So it's not saying we want you to go out there and earn less money. We want to think about how you're invoicing that money. When? Do you need to perform that job that you've just been signed up for on June the 29th? Or can you push it back to next week? Is late June a good time to have a holiday? Do you invoice on milestones? Lots of people do. Do you need to hit that milestone this week? Push it back to next week. It might seem silly. It's a 1 week deferral, but it means a 1 year difference in terms of that when you pay that tax. So the other side of that, the other obvious lever to pull is on your expenses. If you're going to incur the expense anyway, pull it forward. So you can see when we talk about timing, push back your income, pull forward your expenses. Prepay that superannuation that you're going to have to pay by the end of July anyway. Pay it at the end of June. Get the deduction now instead of in a year's time. Do you know what your superannuation limits are? Have you hit them? Plenty of businesses won't pay themselves superannuation as a matter of course, which is absolutely fine. If you're not on payroll, you have a lot of discretion about when you pay super to yourself, but get that tax deduction, pay yourself up to the limit if you want, if it suits you. And if you've got the cash there anyway, particularly if you're not too far off retirement age anyway, and you'll be able to access that money in not too long. The instant asset write-off, geez, it comes and goes, doesn't it? We've got the number $30,000 in there. It's of course $20,000 this year. The instant asset write-off, buy those assets under your limit. Check with your accountant what the limit is, but buy them now, and you'll get a full deduction for them now instead of depreciating over a period of years. Now, you can never be too sure about this instant asset write-off. It has been announced that it will continue into next year, into 2026. But of course, this has not been legislated yet. And the 2025 instant asset write-off was only legislated very recently. So take advantage of when we're certain that which we will have it for 2025. Prepay your annual subscriptions. Small businesses are entitled to a deduction when you pay for your what we call prepayments, when you pay for your yearly subscriptions. So get them in under the threshold, under the 30th of June. Now, Elise there has asked, where is the good news? I'm sorry to say there's no silver bullets. There's no pill that you can take that instantly reduces your tax payable. The real tax efficiency comes from what do we do with that after tax profit in the company? How can we treat that so when it gets into your hip pocket, it's tax effective? So yeah, no silver bullets. Stay compliant, do what you can, pull those two main levers. That's how we, within the company structure, will reduce tax. Anytime an accountant's pulling off a wild and audacious scheme that they recommend to you to reduce tax beyond those things is invariably going to be a bit of a wonky one. And for the accountants in the room who are familiar with Part 4A, we know that if something is purely tax driven, it's going to start to smell a little bit fishy for the ATO. Shane's just asked, with software subscriptions, yes, it does. So if you prepay your year's software subscription before June, that is fully deductible in the year that you pay it. Thanks, Shane. So we've talked about the basics within the company. Okay, what can we do outside of the company? How can we be tax efficient as business owners? The first thing is to do is looking at your structure. Do you have a very, very simple structure? Are you a sole trader? That's the simplest structure. Simple is good, but it really means the tax sits with you. If you're a very profitable business running as a sole trader, you're going to be paying some high rates of tax. Even for those incorporated, if you've incorporated and you or your partner are the sole shareholders or the two dual shareholders, you're very restricted as to what you can do in terms of tax. So what I would say is it time to think about a more complicated structure? Holding companies are good, or an IP holding companies are good. That's really led by legal considerations, by protecting your assets. So we like to ring fence risk from assets as much as possible. But the family trust, and those of you who listen to a few of these presentations, they'll know how excited I get about family trusts, and we'll cover them off very quickly. There are tax considerations that will be relevant to your business structure, particularly around capital gains tax, as I've mentioned. But there are a lot of exemptions in terms of restructuring for small businesses that we can make it almost painless. So when we're looking at this business structure, why do we like the dual company, which is where we talk about a head or a hold co owning the shares in an operating company? Why do we do this? It's very scalable for investment. It's much easier to get money into a holding company structure. It's really future-proof. It allows you to have these different operating companies underneath, but it allows you to attract investment in, loan that money out to your operating companies, but really, again, protect yourself legally there. So that's why we like a good bit of de-risking. It doesn't have to be super complicated. It doesn't add, well, it doesn't double your tax compliance. You can consolidate these entities for tax purposes, so you can actually still lodge one tax return. So it's nice and straightforward. Um, it's fantastic for lots of reasons, attracting capital, and that includes grants and lendings. It's easy to put in through that holdco structure. Now, the family trust with this beautifully, I assume, ChatGPT generated illustration there. Why do we love the family trust? Why does it get me so excited? You still have your holdco and your operating co. Instead of Timothy Quinn owning the shares in that holding company, I'm going to set up something called the Quinn Family Trust. Now, the Quinn Family Trust will own the shares in the holding company rather than Timothy Quinn. What's the point of that? Just some more complications, some more accounting fees. Yeah, that's true. It is a little bit more complicated to do it. But the most important thing is when those shares are owned by the Quinn Family Trust, I get to wear a different hat. I like to put on my special hat from my drawer of dress ups, which is my trustee hat. As the trustee of the Quinn Family Trust, I look around between now and the 30th of June. I look at who in my family can accept a taxable trust distribution. So I look at the salaries or the other earnings of my wife, potentially my adult children. I'm not that old, they're not adult yet, but I can't wait till the day they turn 18 and I can use them for tax purposes. There are plenty of other family members you can bring in. You can even have a company called a corporate beneficiary. But I have that flexibility as the trustee to say, well, I've got $200,000 in profits coming up through my operating company. I can choose to reinvest them in the business, of course. If I would like to take them out, if I would like access to the cash, I can determine, looking at my wife, looking at myself, who is going to be able to accept this in a tax efficient manner. And there is nothing to stop you from doing that. You have absolute discretion. He says, knowing that there are plenty of accountants on the call that will start talking about 100A, yes, you do have to actually pay out physically the profits to those people with some exemptions for family arrangements. Um, but it's still a very, very tax efficient way for families to structure their wealth. And I completely recommend anyone who has the terrible problem of a very profitable business this year, and you're dreading the tax bill that's going to come with it. Talk to us before the 30th of June. There is still time to set up a family trust and to flow the profits through that in a really tax effective manner. There is also additional asset protection. We have to always bring that up, of course. It's a great way not just to own your business, your holding company, your operating company. It's a great way to own your family investments, your listed shares, anything you want. It's really a vehicle to build intergenerational wealth. Now, we just had a couple of questions coming off. Brad said, "Can I change the structure of my company to a trust?" I wouldn't recommend you change the structure of your company. I would recommend, of course, in general, Brad, not to you specifically because I don't know your scenario, but you would change the ownership of your company. So you effectively, if Brad owns the shares in this company, Brad could sell them to Brad's family trust. Now, anytime you sell things like shares in a business, there are capital gains tax considerations. But when you're a small business and you're selling to a family trust that you effectively control, there are exemptions. So we can roll over that capital gains. So recommend you talk to someone. preferably us, Brad. Alberto's asked, employee stocks benefits, are they taxable? Yes, they absolutely are. And in fact, I'm familiar with the Oracle ones in particular because I have a couple of clients who hold them. Yes, they are taxable, and I recommend you get advice on that. Share capital, that's not exciting. I'm going to skip it. This is just talking about capital raising. If you are raising capital, keep your records. Sounds simple. Plenty of people try and go it alone. Please don't. Please talk to a lawyer and get someone who has done it before. It's the sort of thing that if you get it wrong, it's an absolute nightmare to fix. So if you are looking to raise capital between now and 30th of June, please do it professionally and keep those records. Now, just another quick question's come in. At what profit point does the family trust start to make sense? Yeah, depends on your family. It depends if you're running a business where it's just you and you haven't got any other income and the business is making $50,000, better just to pay yourself a $50,000 salary. If you're already drawing $150,000, if you have a wife or a husband or a partner who is not working, and you've got another $150,000 of profits or $100,000 of profits, it will pay for itself. In the typical example, if we see two working parents, one of which is on a higher salary, they run a business with $200,000 profit. Putting that through a family trust can basically save you about $45,000 every year. And so for an extra few $1,000s of complication, makes sense. Alberto, in terms of the percentage of tax rate, the stock benefits will be taxed at your top marginal rate. So whatever that is, depending on your salary. Now, ESIC for the employee stage innovation company. ESIC isn't going to be a deduction for your business. It's going to be a deduction, or even better, a tax offset for your shareholders. So not for you, unfortunately, as the founders, probably on this call. But if you're out there looking to attract investment, either from angels or family members or slightly larger, you can basically go in, if you can wave a letter that says, we're eligible for the ESIC offset, this will give your potential investors a huge kick up the pants to get them to sign that check. It is a 20% tax offset on eligible amounts, and this is subject to different thresholds depending on whether you're a professional or an amateur investor. But basically, this is a way. Imagine if you put $100,000 in, you get a $20,000 tax offset. So an instant cut to your tax bill of $20,000. And even better, if you're in this ESIC, you've been convinced by the founders to put your money in, the business shoots lights out, you sell it 5 years later or between 1 and 10 years later, you can sell your investment in those companies CGT free. Now that is an incredible bonus. So obviously you're taking a risk, as you always are, investing in companies like this. But if it pays off, gee, it pays off well, particularly from a tax side of things. So I do recommend if you are an innovative company and you can self-assess that, you can certainly use your accountant to help you self-assess that. Um, there are various ways. There are points tests, there are principles tests. If you can qualify for it, it will really become a very attractive investment for potential investors. So have a look at it. Even though it's not a deduction for you, it can help you out. R&D, gee, this is a big one. It's probably going to come under some close attention. It's been under close attention for a number of years. It's going to be increasing. It's a incredibly expensive tax incentive offered by the Australian government. Lots of people do qualify for it. You might have seen some stories. They've started publishing lists of who gets exactly what. So if you want to have a sticky beak, you can actually find the publicly available list of who has received R&D tax incentives. Why is this incentive so popular? It's massive. It's refundable. For small pre-revenue or certainly pre-profit companies who are doing eligible investment, you can get back as a cash refund into your bank account 43.5% of your eligible spend. So that's for small companies. It becomes non-refundable for large companies, but again, that threshold is significant. Most companies applying for it do receive that as a cash benefit. So it's very, very expensive. It doesn't just mean because you're creating an app that you're going to you're going to get that. It's a complicated process. There are two regulators. So you have to apply first of all to Oz Industry, who will look over your application. They want to see that there's new knowledge being generated, that there is a hypothesis that you think you can achieve a certain objective, but you're not sure. You have to do experimentation to find it. It's a complex process. There's plenty of people out there that do it professionally. I've done it myself for a number of years. It is available still out there. So even though you see there is some moves to try and make it a bit stricter, for now it's still there. And of course, you should take advantage of what is out there. So do talk to us or talk to if you have an existing R&D professional that you use. There's plenty of good ones out there. There's a few cowboys. We're happy to point you in the right direction. Very, very valuable offset. ESOP, we've already had a question about ESOP. ESOP or ESS, depending on which legislation you read, it's called ESS in Australia, but everyone thinks of it as an ESOP. It is basically giving or selling shares or rights to buy shares in your company to your employees or your advisors, people that are like employees. Now, why would you do this? It is, of course, a great way to attract and retain staff, particularly if you're cash poor. If you're a startup going out there, you might not be able to offer the same amount of cash benefit as the big players, as the oracles of this world. But being able to offer employee share options or employee shares themselves is a great way to do it without, really having to dip into your wallet. Typically, we see companies putting aside, and when I say companies, particular types of growth-oriented companies, we typically see them putting aside 10 to 15% of their shares in a pool to basically be accessed by multiple staff. It doesn't mean you offer your first head of development 10%. It means you offer them 1 or 2% and put some aside for the future. When we talk about a vesting period, that means that, of course, you don't give them over day one because that's not a good way to incentivize anyone. The idea is typically a 4-year schedule is very common, where you might get a quarter of your entitlement to shares every year for 4 years, usually after a 1 year, what we call cliff, so basically a qualification period. Now, employee share schemes, if you think about just a way of, by default, if you didn't know that this legislation existed and you just went out there and gave shares to your employees, they would be taxed on the value of those shares when they receive them. No one wants that. You don't want to be taxed on a bit of paper. So we typically see small companies trying to qualify for what we call the startup ESS, the startup concession. Now, that's a particularly generous scheme where the way that you value your shares and your options, there's a very shorthand way of doing that, that often for startup companies will say, well, actually, they're worth nothing. Doesn't mean they'll be worth nothing in 5 years' time, but we're happy to stick with the value at today, and the value will be very small. So if you can fit into that, if your company's been running for less than 10 years, and I know from experience that Lawpath has just hit 10 years in a month, but if you're under 10 years, the startup ESS is incredibly valuable. Look, what does a small business get over the big dogs? We had a smaller tax rate, so I can't remember when it was now. It was a few years back where everyone paid the same rate of company tax. It was 30%. Small businesses then gradually came down and down and down. Small businesses are currently taxed at 25%. There's no move to reduce that any further, but there is a whole 5% difference between small businesses and big businesses. So that's incredibly valuable. Another change from in the past, these startup expenses, when you're paying your company incorporation, when you're paying your legals and your accounting fees up front, there was a crazy thought out there that this was not directly related to you earning an income, and therefore you couldn't deduct it straight away. There were some expenses that were treated as what we call black hole that you had to depreciate. There were some expenses that were just sitting on your balance sheet and completely useless until you sold the thing. That's changed. It's a very sensible change. Now, when you're paying for these sort of startup costs, the sort of costs that you'd be expecting to pay, your government fees and your advice for government fees on setting up your business, you can deduct them in year one. So very straightforward change, very sensible, but very valuable in year one. Lots of questions always come to me from my clients saying, oh no, I've paid them myself. I've paid them from my personal credit card because we didn't have a business bank account. That is absolutely fine. Keep the receipts, keep the records. We can scoop them in to your company when the company is up and running by the way of a director's loan or a shareholder's loan. So they're not lost just because you didn't pay for them out of the company. The simplified depreciation rules for those expenses you haven't been able to immediately deduct, you can put them in these pools. It streamlines depreciation, supposedly. I think in these days, if you're running a Xero, or an MYB or a QuickBooks online, it's quite easy to do the normal depreciation anyway. But I guess pools are a little bit easier, more options for you. And of course, the write-off. And you can delete that little caution from your mind. The legislation has now been passed for 2025. As I mentioned, it hasn't been passed yet for 2026. Shane, we can absolutely reach out to you about your business records. So I'll arrange for someone to chat to you after. Please do keep the questions coming if you'd like to. So just talking just in a little bit more detail about those immediately deductible expenses. So as a lot of you will know, you start to get hit with fees as soon as you walk in the door, isn't it? At most legal firms or most accounting firms, they'll expect some they'll expect to have an engagement with you, and then you'll get a surprise bill at the end of your engagement that's much more than you bargained for. Of course, we don't do that at Lawpath. Everything is upfront billing, no surprises. But for those of you that have been copped with those bills after the event, at least you can get the tax deduction for it. Typically, that's when you're looking at your business structure, whether you incorporate, whether you have a holding company or a family trust. Any advice that you've received there is going to be deductible for your business. Any sort of professional advice about viability. So if you're looking at cash flow forecasts, any models or things like that, or feasibility studies, any research into the industry, if you're running a cafe, doing your market research about cafes in the area and pricing and things like that. Likewise, any other due diligence when you're looking at taking on a business, that is all going to be deductible. And I'll just caution on the costs associated with raising capital. Sometimes they are, sometimes they aren't. Do talk to your accountant about the costs of raising capital and how you can properly treat that. Of course, government fees, my favorite industry body, my favorite regulator, ASIC, gee, they're good at charging fees. For small businesses, they don't seem to be great at much else, but they're very good at lopping on a fee and a late fee on top of that, and a late fee for missing your notice of the late fee. So unfortunately, all my love out to ASIC, they can't handle a letter to save themselves, but they can issue bills and fees very, very well. At least, again, we as small business owners do get a deduction for those charges. Why are we talking about budgeting? Maybe because I got you in the room on the pretense that we're only going to talk about silver bullet tax efficiency. Budgeting isn't really going to be tax efficiency, but it is going to save you money. So it sort of works the same way, doesn't it? Now is the time to look at your budget. Don't think about it after the start of the financial year when you're going hell for leather on the running of your business. If you're already having to pause to do last year's tax returns, which are due on the 15th of May, as we all know, or a little bit into June if you're a bit cheeky and get your accountant to lodge them, you're already having to think about last year. You're already looking at last year's records. Now's the time to think about next year. If you are with the sort of accountant that you only speak to once a year after the end of the year, as part of your year-end wrap-up, now that you've got them on the hook, you're talking about your compliance. Now's the time to talk about next year. Now, at Lawpath, we do engage, we offer everyone complimentary tax planning consultations with the client manager. So we'll be talking to our tax clients about this anyway. But now's the time. Have a business strategy in place. It's not set and forget. Your business strategy might have been great 2 years ago. Maybe you export to the United States and maybe that business strategy has gone out the window. Maybe your supply chain has been spooked by Mr. President Trump and the tariffs coming in, and all of your costs have changed. Your business strategy is due for another look. You might need to set some new objectives or change them. And perhaps your growth plan has changed too. Now's the time to have a look at it. Reassess the base scenarios. Reassess what's going on with inflation, what's going on with the cost of living. Plenty of small businesses are really sensitive to changes in take-home income. Does the state of the economy work for you in that way? Now's the time to do it. I just had a question come in. What's the best way to go about expenses for a partnership business where the partners have not paid themselves. Partnerships are a bit old school. You don't see them too often anymore. Um, they're quite historical, I guess. It depends, is the disappointing answer I'm going to give you. The easiest way to do it is a partnership, what we call a drawing. So in a partnership, any leftover profits at the end of the year will get split according to your partnership agreement, often 50-50. You could, of course, put yourself on payroll. Just be wary that going on payroll, you do have to report that using single touch payroll. You'll have to pay superannuation, things like that. So the most common way we see is partnership drawings. Thank you for the question. Okay, for those businesses that have been going for a little while, those those what we call the scale ups. So if you're into growth, fantastic. Congratulations. You've got where most businesses don't get to, because, of course, as we know, uh, the majority of small businesses will shut down within 5 years of operation. But you've made it work. You're profitable. When I say don't set and forget, it goes doubly for expanding businesses. Do you actually need to split off into a new company? Are you doing things that are so wildly different in to what you first started doing that perhaps it's time to have two operating companies? Perhaps you actually want to sell one of them off and maintain one of them. Splitting a company is not impossible to do. Straightforward. There's lots of professionals that do it for a living, but it is probably time to have a think about it. In your Xero or your QuickBooks or your MYOB, is it all just treated as one business? Are you doing a bit of tracking? You can tag things very easily and you can set up your chart of accounts to be able to follow your certain business lines. Can be very easy when you're profitable to just let it sit there and be happy with the profits, even if your two core product lines, maybe one of them is enormously profitable and the other one's loss making. So by setting up trafficking, terrible. Setting up your tracking, you can easily see what works and what doesn't. How are you going to fund that expansion? Debt versus equity is the old tricky one to choose between. Of course, no one likes paying interest, but likewise, no one likes giving away their company. So debt versus equity, there are positives and negatives to both, and your accountant can help you work through that. Again, marketing and sales, that plan that you set 5 years ago is probably not going to be relevant for a new business today or an expanding business today. Your digital ad spend has changed rapidly. I know Google AdWords are not what they used to. They're incredibly expensive. Making sure that when we look at your tax structure, is there any leakage? It can happen. It sounds gross, and it is. It's gross to see when you have to do a set of financial statements where you can tell that it's not tax efficient. Do make sure that your professional advisors have had a look at your structure. We talked about grants and concessions earlier. Make sure you're thinking about all of them. When I talk about CFO, really just a look at your finance function. If you're a profitable, well-functioning small business and you yourself are wearing too many hats and you find yourself up at 10 o'clock on Friday night with a glass of wine doing your bookkeeping, it's probably time to give it over. Probably time to pay for a cheaper bookkeeping resource that can let you focus on maybe a little bit of downtime, dare I say, or the parts of your business where you can add the most value. Have you checked your cash flow forecasts and do they include tax? Plenty of cash flow forecasts I see haven't factored in pay-as-you-go withholding. They haven't factored in GST, even income tax or tax installments for next year. Do make sure that it's inclusive of tax, and always just seek advice. That's what we're here for at Lawpath. We like doing this. We like helping. So just have a chat to us. Just before I skip to the next one, I'll just have a quick look at some questions. Mark's asked, yes, he's paid for trademarks and merchandise and purchase. All of it's claimable. Yeah, Mark, all expenses related to the business that you've raised there are completely tax deductible. And Alberto's asked, he started a business on the 10th of April. Do you need to declare? Yes, absolutely. Yeah. So if you've started within the 2025 tax year, which runs from 1 July 24 to 30th of June 2025, you will have to do a tax return for this year. So, Alberto, we can help you out with that. We talked about finance function as well. It doesn't just mean a CFO, it means looking at all of your function and who's doing what in terms of your accounting. Now, this is a very, very depressing area for anyone that's excited about business expansion. Pardon me, because the more successful you get, the more taxes you're going to be exposed to. If you thought it was simple to run a business and all you had to do was five tax lodgements a year or six, get ready for some bad news. Fringe benefits tax. One of the biggest mistakes I see in tax compliance coming through is small businesses trying to do the right things by their employees and providing non-cash benefits. Plenty of foreign companies come in and start doling out health insurance to their employees because that's the common thing in the United States. Um, I am cautioning you not to provide non-cash benefits or fringe benefits to your employees unless they're covered by a particular exemption, like laptops and phones, things like that. The base scenario, if you provide an employee with a non-cash benefit, it will be taxed at 47%, regardless of that employee's level of income. So even someone on $30,000, $40,000 who would have a very, very low tax rate for cash benefits you gave them, if you were to give them non-cash benefits, it'll be taxed through the roof. It will also add to your company's tax compliance obligations. You'll have to register for FBT. You'll have to do an FBT return. It's fiddly. It's not fun. It basically, the way to think about it, if you're providing a $1,000 non-cash benefit to your employees, expect it to cost $2,000. That's the way it works. You basically treat it as it's treated as an after tax cash payment. So it's quite painful. Do talk to someone about FBT. We're in the throes of it at the moment in April. Plenty of people lodge them late, so don't think that just because you've missed the year that that's it. We can sort you out for catch up work. Payroll tax. Now, you might be thinking, don't I already do payroll tax? Don't I already pay it? No, probably not. You probably pay PAYG withholding, PAGW, PAYGW, which is to the Commonwealth government, to the ATO. That's on your BAS or your monthly IAS. That's when you're paying the money that you've withheld from your employees for tax, and you're paying that to the ATO. Payroll tax is different. It's a state level tax, slightly different in every state. The rules are becoming more and more similar, but the rates are still different. Once you're a large employer, and that can be anything from around $1 million or over a year in terms of salaries, you'll pay an additional rate of tax on amounts above that threshold, which I think in New South Wales is around 5.5%. Bit different for every state. So again, painful, but it must be done. Your reporting frequency to the ATO might increase. You might have been just a very simple annual reporter. You might move to quarterly. You might move from quarterly to monthly. If you're super big, you might go from monthly to 8 days after payment for some large withholders. Your frequencies will go up. And if you're profitable last year, expect to get the dreaded letter, welcome to the PAYG installment system, which is basically saying the ATO is congratulating you on being so profitable last year that you paid tax, that this year we'd like you to prepay next year's tax. So we're going to put a finger in the air and estimate we think you're going to pay $100,000 in tax next year. You can start paying us $25,000 a quarter. Thank you very much. Painful, but do expect it to come if you're profitable. Look, if you're an expanding business, you might have some capital gains tax issues coming up on restructure or perhaps disposing your assets. Please do talk to a professional. It sounds all doom and gloom. There are lots of really, really good concessions and exemptions and rollovers for capital gains tax for small businesses. But if you don't know it, you can't do it. Director loans. So this is not a Div 7A webinar for any of you who've heard that statement before, but do be aware if you are borrowing money from your company, the ATO is taking a fairly reasonable view that what you are doing is trying to pay yourself without having paid tax on that profit first. So anytime you're borrowing money from your company, it will either be treated as a deemed dividend without franking credits attached, so quite painful to your personal tax return, or you'll have to put in place a complying loan agreement. Very, very dry, very dull, but very important to get it right. Very important to tell your accountant if they don't already know that you have that loan in place. We mentioned 100A before. That's really just for family trusts. It's making sure you're not doing the wrong thing and income splitting without going through the right steps. Got some questions and even some commentary on the questions saying good questions. Fantastic. Well, we should really have a look at them. So Adriana has asked, are expenses for professional plans always tax deductible? E.g. Lawpath plans? Very good question. Yes, they are always deductible. And in fact, if you were to sign up for an annual plan between now and the 30th of June, the full cost will be deductible this year. You don't have to stretch it out. What's the difference between immediate deductions? The question there was just it was really to make the differentiation between the old state of affairs where expenses that you incurred in starting up a business weren't tax deductible, weren't immediately tax deductible. So the difference is nothing now, Adriana. If you've incurred an expense for setting up a business or just an ongoing business, they are all treated the same way as being deductible when incurred. Very good question indeed. Then we've had the question, what's the typical way of claiming for time spent in a startup pre-revenue? Unfortunately, there is no tax deduction for time. Yeah, it's a good question. Plenty of people ask it. You might think you're pouring your heart and soul into a small business, into a pre-revenue business. Can I get a deduction for that? Because I've effectively given up income. Unfortunately not. No tax deduction for that. But a good question again. I might hand you back to my colleague. Joel, are you on the line?
Certainly am. Thank you so much, Tim. Um, Questions have been amazing today, guys. Keep them coming. This gentleman has 17 years of experience and he's offering you free advice, so please jump on board. Um, Here comes the dreaded part where I try to tell everyone about the products. Look, we're all adults here. If you found that what Tim has been describing has been exceptional and you feel like there's so much more you can learn, more money to save, and more ventures you can, I guess, indulge in or even consider, then certainly we can assist you with our plans. Um, what do we have? Legal, accounting, and tax. Now, essentially, the legal advice, this isn't a legal topic webinar, but we always like to mention it. It's in the name. Legal advice, you get unlimited 30-minute consultations with a senior lawyer for 12 months. That means whenever you have an issue, depending, especially if you're a new business, if you have an issue, it's a single click, call the person same day or next day. If you require documentation for compliance, if there are any external documents that you need reviewed, let's say you have investors coming in or perhaps hiring new employees, whatever it may be, we can guide you. Documents aren't as complex if you take your time and go through them and read them. However, small businesses and I'd say most of us, we don't really have time, nor do we have the patience to go through everything. So having just that shadow to monitor what you're doing and give you that advice and save time, essentially, that's what we can provide with the legal advice plan, as well as our essentials plan, which is just the document library. Now, in regards to the accounting and tax, for the most part, if you are self-sufficient and you like to do your own accounts through Xero, MyOb, or any one of these other, online accounting resources, or even just, I guess, if you're hoping to transition from Excel spreadsheets over to one of these online appliances, then we can assist you there. We can assist you at just getting a better understanding on how to report your bookkeeping, your invoicing, payroll. If you're taking on employees for the first time, it can be a very stressful thing for new businesses. So we can guide you there. And there's a lot in regards to business structuring that we can assist you with as well. And then obviously, for those who are familiar with what we do, the legal and accounting is very DIY with someone to assist you. But on the tax side of things, we will take all the stress out of you, off your hands. It's VAT statements, tax returns, end of financial year reports, and obviously the initial tax consultation to really build a picture of what you're looking to do and how we can assist you moving forward. Tim, if I may, I always like to be as transparent as possible because it always comes down to um, pricing. So I do believe we are offering 30% off quarterly for our tax plan, which comes to about $630 per quarter. If I may ask you, why would people spend $630 per quarter with Lawpath?
Yeah, it's a pretty simple equation. If you don't think that you're going to get more back from that, more value out of it, then you shouldn't come with us. But I can assure you, getting an accountant on board before financial year, having them there all year, the cost savings that you will get, the tax savings compared to just talking to an accountant once a year, and just looking historically, are immense. We can really make big changes to your taxable income now that we can't make come 1 July if we've left it too late. So really the value we offer is they are very, very cheap subscriptions for what they are. As you know, I've been doing this for a very, very long time. I can't remember the last time I was able to offer small business tax compliance this cheap. It would have had to be 15, 20 years ago in terms of, the costing that we have, the model that we have at Lawpath being built on this really strong tech platform means that we don't do a lot of time as accountants doing the administration stuff. We can basically just really devote our time working for our customers. So we really pride ourselves on knowing your business. So the first thing that will happen when you sign up to a Lawpath tax plan is you will talk to a real person who sits next to me in our Sydney office, who will be your accountant. We'll learn your business. We'll work out now the steps we need to take. We'll keep you compliant. So 600 odd dollars a quarter is peace of mind. It means that your compliance is up to date. You don't have to worry about it. It also means that you know that someone is there fighting for you to reduce your tax bill. That's what I'd say.
Brilliant. Thank you, Tim. And if I may, obviously there's a million questions our attendees could be asking that they haven't asked yet. But is there one in particular you're hoping to see someone ask that's very relevant to what this webinar is about?
All questions are good questions, and they're all varied. And before I try and answer, let's see if some more people will pop in with them. Is there a
Good call.
particular revenue amount that we recommend registering for GST? Good question. If you're earning more than $75,000 a year, you have to register for GST. I actually recommend for lots of small businesses that you do it from day one. You get used to doing a BAS when it's easy and straightforward and cheap. Most importantly, if you're spending more than you're earning, you might be in a GST refund position. So get those GST expenses on things like your Lawpath subscription. We, of course, have to charge you GST. We don't get any benefit from it, goes straight to the ATO. Get that back from the ATO. So register from GST from day one is my recommendation. Can you backdate claiming GST? Yeah, you can. It's not the easiest thing in the world, but we do it routinely. We can backdate your GST registration for you. Thanks, Mark. We look forward to when you've got your business set up and running. Um, I guess you asked me the question, Joel, what would I hope would be asked? I think a lot of it is really around making sure people aren't shy. Don't think that you're going to ask stupid questions to your accountant. There are no stupid questions in tax. We get it. It's complicated. I've been doing this for a very, very long time. There's still new bits I'm still learning. There's still bits that we all come across. There's always new tax laws. Ask questions. Go in with a mindset of, I think this is deductible, or I hope this is deductible. Don't try and go through your expenses yourself. Go out with a mindset that you want everything you've ever touched to be deductible. We might, share a little smirk that maybe you're being a bit cheeky and you're trying it on. That's okay. We'll tell you what expenses are deductible and what are not. But if we don't know about them, we can't deduct them. So I would say what I really want people to ask is ask what look like silly questions about deductions. And I'll happily tell you no if they're not deductible, but maybe you might surprise yourself and find something that is.
I'd also like to mention it's the same in regards to the legal advice as well. If you are speaking to one of our lawyers, no question's a dumb question. You're paying them. Sorry, you're paying them. You've paid for this subscription, so they're at your disposal. It's free range. It's free game. It's everything you want.
Yeah, absolutely. We've just had a question there. Do we offer free consults for the first appointment? Well, the way our accounting plan works is that it's a very, very cheap subscription, and once you're in, you can book as many as you want. There's no fees for every additional consult. So, is there a free consult before? Look, I would say get in touch with us. Let's see what we can do. We obviously have a fantastic sales team that know our products very well, but often the questions that come through will require a bit of a nudge from an accountant. And of course, we always encourage you to talk to an accountant when you're considering Lawpath products. So we'd be happy to talk to you. Some more questions coming through about inclusions, things like that. I just want to scroll up to make sure I don't miss any. If we register for GST and hardly make any income, can you still claim expenses? Absolutely, you certainly can. And the consults are 30 minutes long, and that's by phone or by video chat on our platform. Does the accounting include bookkeeping? No, it doesn't. So we do encourage self-service. What I would encourage you to do, and what I've seen most small business owners can do, is if you sign up on the tax compliance and the accounting advice, we will help you on these 30-minute consultations set up your Xero or your other accounting platform. We'll teach you how to use it. You might find that you don't need a bookkeeper. You can save yourself a fortune by doing it yourself. Xero is very much designed for DIY small business owners. It's as simple as once we've helped you get it set up, just matching things coming through your bank, which are automatically uploaded into Xero with your invoices. And there's a lot of AI tools that will help you match that for you. We can also offer bookkeeping if you just don't want to do it, if you hate it, if you want us to do it, we can certainly offer that as an additional service. And then we've had the question, do computers and office setup count as business assets for full deduction if you use it at home? Yes. Yeah. If you're using them in your business, doesn't matter where they sit, you can have them on my laptop's on my kitchen table right now. I've certainly deducted that. So yeah, there's no problem doing that. We do still have a few minutes as well. If anyone is still got a burning question, please do send it through. Otherwise, I'll just let Joel talk at you. Yeah, that's correct. You don't need to meet a certain income level in order to claim GST credits if you are registered for GST. That's exactly right.
Does anyone have any other accounting related questions that aren't necessarily attributed to this webinar that anyone wishes to ask?
Yeah, jump in. There's not many areas of tax I haven't touched. I've been here for long enough that I've probably got a good working knowledge if you want to ask them. Your accountant has told you that you should deregister for GST. I'm hoping that your accountant has weighed up the costs and benefits of you doing that, and potentially you're not able to claim enough GST credits to make it worthwhile. So I would assume if your accountant, if he or she is saying, well, it costs you $300 to do your BAS or $500 to do your BAS, and you're only getting back $50 in credits, maybe it's not worth doing. So that would be why potentially your accountant may have advised you that, potentially. And we've had another person who's advised not to register yet. Okay, probably the same reason. Arguably, you're not going to be incurring enough costs to make it worthwhile. I think the beauty of being on something like a Lawpath subscription is it's included. Why not make the most of it? You know, you when you have a model like this that is so cheap and so accessible, I would say get every cent, even if your quarterly BAS is only getting you $100 back. That can mean the difference between a business falling over or thriving in the early stages. So I think get yourself out of the trap of having to pay for a BAS and wondering whether it's going to be worth it. I'd say get on a subscription where we'll do it for you. Mandeep's asked a good question. Does Lawpath platform have self-managed super fund documents? We don't touch self-managed super funds. I'm certainly happy to refer you to someone else who does. It's a very specialized area that is fraught with lots of complexity. It doesn't really fit our model for small business owners, but certainly I used to work in self-managed super. Commend you for giving it a go, and we can help you with a referral if you'd like. Very good question. I like this one from Dane. If half of the year you had a salary with a high tax rate and part of the year less, the tax rates separate or combined? It's all combined. So it doesn't matter where you've earned your income. It doesn't matter if half of the year you're on good coin over working for BHP or someone else or whoever it will be. And then separately in the second part of the year, you go to an ABN sole trader. All of your income is treated the same. So you might be in a nice position if you earned less from your ABN, if you were paying a high tax rate in your first 6 months, then you might be due a tax refund because they might have effectively withheld more tax than they needed to. But yeah, it all just goes into one pot as taxable income. And I think we might have exhausted the questions with one whole minute to spare. Geez, we did well today. Can ABN deductions come off salary income? It's a tricky one. Again, it'll depend. Is the not particularly fun answer. There are times where it can, and there are times where they'll be sort of segmented as non-commercial losses and only being able to apply it against ABN income. So, Dane, just check with your accountant.
I'll just go ahead and throw in here for anyone who's a bit late. We will send an email after this with the slideshow presentation. And if there are any burning questions that you weren't able to get through, maybe you're on your lunch break and that annoying coworker's bothering you right now and you can't focus, go ahead and send those questions over to me via the email. I'll be more than happy to address them with Tim and see if we can get you a response. And I will also put in the information related to the offer for the 30% off quarterly discount on our tax plan. And then I'm more than happy to address any other kind of interest in the legal or the accounting as well if someone's interested. If anyone would like me to contact them directly after this call to speak about some of our offers, please just go ahead and type in yes in the webinar chat, and I would be more than happy to share a bit of extra information if you like. And as you can see on the screen here, we do have our bundle and save. So it's a new feature we have. If you wanted to place two plans together, let's say you were interested in the legal advice and then maybe the tax as well, instead of paying the two individual prices, we splice the two together and then throw a 40% off discount on top. Um, that should be everything from me. Tim, always a pleasure as always, sir. I, I'm not too sure what next week's webinar is. I think it might be something related to intellectual property. So if that is of interest to anyone, please, by all means, go ahead and get involved and bring some questions. We absolutely love the questions. You know, it's able to help us pick up on things that we may not necessarily have prepared in the slideshow. So yeah, it's always helpful.
Thanks
Beautiful.
very much. Thanks everyone for coming and for your questions. That was a lot of fun today. Really appreciate it.